Now, India's e-commerce frenzy has created giants, of course, of the likes of Flipkart and Snapdeals, and the sector has witnessed some mind-boggling valuations. However, considering the kind of fallout we've seen in global financial markets and the fact that investors are becoming a little risk-averse, is the bubble, even in this segment, set to burst as funding, particularly the larger deals, seems to be slowing down? We've heard some commentary coming in, whether it be from big investors like Matrix, SoftBank, and so forth. So today we put that question to Sandeep Murthy, who's also joining us in studio today, partner in Lightbox, a $100 million venture fund, which includes the likes of ClearTrip, InMobi, its portfolio of companies, and several more. Sandeep, thanks so much for joining us.
Thank you.
Well, that is the big question, Sandeep. How affected is the e-commerce space as well by what's currently going on globally in financial markets? Are you feeling the jitters? Is sentiment being affected?
Look, I think in general, we have to believe in the idea that stuff will go up and stuff will come down. So, every time it goes up, the question becomes, oh my God, is it a bubble? Are valuations out of control? What are we going to do? So I imagine 3 weeks ago, you would have had people here talking about, no, it's not a bubble, life is okay. Yeah. So, I think that we actually believe that it was a bubble, and it is a bubble. And a bubble is a good thing. If you take the approach of sort of creative destruction and the idea that stuff has to grow and then stuff has to die, and in order to change consumer behavior during the grow time, you need excess capital. So the bubble was a good thing and remains a good thing, and it's a necessary part. But along with the bubble will come the need for things to actually die. And so it's an evolutionary cycle. And so with that in mind, yeah, it seems like we're entering the next phase, and it seems like now there'll be a little bit of contraction, a little bit of weeding out. There's always the statement that a rising tide lifts all boats. And so everything has gone up beautifully. And during the boom, the question is really, how did you use your time? Did you become sort of fat and happy and lazy, or did you get fit and healthy? And so now, as the wave goes out, you start to have to figure out, okay, well, who's going to survive? And now the battle really starts, and you have to kind of work through that phase. So yeah, it's coming.
So that's interesting, Sandeep. I want to actually, before I explore that point with you, I'll also bring in another view. When we were talking about a bubble being built up, we in fact spoke to Ronnie Screwvala to get a perspective from him, from some of the companies that he's been mentoring as well, and what he's also seen as an entrepreneur. Let's just listen into his thoughts on whether or not we are seeing a bubble.
Most people feel that their first moment is only that they can't go forward unless they can get a private equity or an investment. And I would urge a lot of people to say that's not the hallelujah moment. If you've got a plan and if you've got something, put in a little bit of your own resources, cut your coat according to your cloth, and actually get to a particular level, rather than seeking always that until I get my equity, I can't go forward. My sense is, and that's been my experience, your first funding is always your easiest. That's the time when you're at a good crossroad, you can evaluate both the pros and the cons. But imagine a year later, you've got 30 people working for you, you've got many customers, and then at that stage, your second round of funding, third round of funding is going to be equally much more challenging than the first. I don't see a bubble at all, because of the simple reason that the market is growing. So if you look at e-commerce 5 or 7 years back, I don't think people would have actually dreamt that for India's psyche, which is a very strong touch and feel psyche, where logistics is still a challenge, and where people don't have faith in credit cards being swiped without them being misused, that people will actually go with this level to start shopping online. And for various products, so from furniture to fashion, you can take the books and the mobiles and say those are slightly more inanimate things that you don't have to touch and feel them. So I think that's happened. I think the other sectors of health, education, whatever else are moving to that. So I think the business and the consumption is very much there. There is a certain segment of investors, and I'm not faulting that, that might be their point of view, that they actually do encourage and say, right now, India is going to blow out of proportion in terms of consumption patterns, so forget about profitability and just go out and get market share. But when market share is subsidized with discounts where your gross margins are lower than break even, I'm not getting that vision. I might be entirely wrong, and I might miss an entire new wave of things, but I just think road to profitability is very critical and important. And constantly discounting people, where the consumption pattern is being forcefully stimulated with discounts that at some stage will not hold good, I don't get it. So I think my one-line advice is you need to figure out at a gross margin level that you need to build a profitable business.
Okay, let's take a couple of those points forward. Sandeep, I want to get your view in on this as well. Now, first of all, Ronnie is saying that he doesn't see a bubble. He sees the space for everyone. But at the same time, he is also acknowledging that perhaps some people may be getting in with expectations of, huge success or returns without actually having a proper business model.
Yeah, so I guess, look, a bubble facilitates the idea of changing consumer behavior. And he also mentioned the idea that people are providing discounts at an irrational level. Yeah. And so I encourage you to change your behavior. If you've been used to going to the corner shop to get your provisions or whatever it might be, I want you to buy it online. I have to give you an incentive. So I give you a discount. Now that discount changes your behavior. And now you're in this world. And now hopefully my dream is that I'll retain you here. I'll monetize you over time. And so you have the statement of lifetime value of a customer. It used to be in the 90s eyeballs. These were the fantastic words that people used to think about. And so as a result, you kind of look at it and you say, listen, yeah, there has to be some sort of bubble-driven incentive to create that. Now, that doesn't mean that there aren't real businesses that are getting built in the midst of that. So the idea of, look, I'm gonna end up finding a way to create something profitable, something sustainable, build a product that works, I think is viable. And we've talked a lot about that during the bubble to say that, actually, if you go back and you think about Facebook and MySpace. So MySpace was bought at some point in time by News Corp for some value that people thought was a great deal and it was a good opportunity and everything. Turned out that they ended up getting sold for a fraction of that, 35 million. When Microsoft invested in Facebook, I think they invested at maybe a 15 billion valuation. Today, Facebook's at over a 200 billion valuation. So that looked crazy when Microsoft did it, and it looked amazing when MySpace did their deal. And now suddenly you look at the two and you say, okay, well, wow, I guess one was a great deal and one was not such a great deal. So there will be gems. You just have to work through it. You have to build product differentiation. And so bubble isn't a bad thing.
Okay.
And similarly, downturn isn't a bad thing. They're both required activities in evolution.
So maybe what you're saying is it's more of a stabilizing factor rather than a pitfall. You're not saying the industry is going to go bust or anything, unlike perhaps, and Priyank can jump in there, the debate in the stock markets. But
the point is, I mean, I'm just trying to put the analogy out here to work when we talk about the listed space as well. And Sandeep, the interesting part is, as you're saying, it gives opportunity to guys who are probably not in the market to come in when you see these kind of steep corrections, valuations somewhat adjust to the reality as well. The point here is the guys who are already in, it's important to then see the kind of strength that they can actually hold on to. A similar question to you as well when we talk about the PE deals or the valuation from venture capitalists out here as well. How much strength do you really see in the ventures out there right now that'll be able to probably withstand that bubble? That's probably the bigger question that's worrying a lot of investors.
So we'll look at this and taking the public side as well, right? So we were looking at this actually and we said TCS and Infosys. I mean, they've diverged significantly in the last 5 years, right? And if you go back and look at it, from 2000 till maybe about 2010, they kind of mirrored each other and they were kind of working together. They were doing what the market was doing. Market went up, they went up, and they worked well. And actually, we were reading back on a bunch of things. In 2007 to 2010, they seemed to have retrenched, fixed a lot of things, decided, and 2007 was not bad as a year. It was during an upcycle that they started to reassess what is their core and what are they really going to be driving as value. They saw the benefits of that when the market turned down and then started to go back up the next time. And 2010 on, when the market went up, they were well positioned to take advantage of that. So to your point, I think that companies, whether they're public or private, have the same set of challenges. Agreed. The question is, what are you doing with your time? I said before, are you getting fat and lazy or are you getting fit and healthy? And so during the boom time, it's an amazing time to actually just get your house in order. Every company has a base of fixed costs. Can you cut out as much of that nonsense as you possibly can? I'll give you another example. At ClearTrip, when we started early on, when 2008 hit, just before the crisis hit, oil hit $100 a barrel. And so that happened, thankfully, before the global financial crisis hit, because that forced us to correct. When we corrected, we started to look at things. We said, oh my God, we have all these people doing reconciliation in finance, which was not essential. We could automate some of this stuff. We could put those people to more productive use somewhere else. So you optimize, you refine. Now, for that business, for example, we operate with such tight efficiency in all our overheads that as a cycle comes again, you're able to accelerate. So I think it applies whether you're public or private, and the thought process is not that, oh my God, there's a blanket rule. So the other question is really, so if you say, look, it's a downturn, what should people do? The question is, okay, what's your time horizon and what's your risk appetite? Right? I mean, this is the same question for every investment product out there. You say, is it good or bad? It depends.
So do you feel, though, that perhaps, when we're talking about investment becoming a little bit more wise, I mean, there seemed to be this mad gush, the last couple of months, or at least that's the sense we were getting. Do you feel that now there's a bit more focus when it comes to the bigger deals on making sure that they fit some of these parameters? I mean, how do you judge? I mean, what are you looking at in terms of now established business models and what they've managed to achieve? Because until now, it was all about growth over profitability.
So I think that there's no escaping a world where when the upcycle is going, people don't care about anything, right? So you can, I can sit back and say, no, you guys are absolutely wrong. You must focus on unit economics, even during an upcycle. But I'll get killed because market share will go and some other guy will spend and burn money like crazy. So you have to play the right game at the right time. So in an upcycle, you have to burn. It just sucks, it's reality, but you have to go and play that game and you have to burn. In a down cycle, you have to be ready to be more efficient. So, but you can't get ready, because the other thing that's happened is the cycles used to be nice and smooth like this. Now they're like jagged cliffs, like and so you don't have enough time to adjust your business when it's coming down. You have to have been ready for it. So you have to be able to pull off the marketing costs. You have to be able to change all your variable aspects of your business so that you can survive that time. What you can do, and that's why actually, for us as an investor, it starts pre-investment. So we make our investment decision based on the idea, are you going to be sustainably differentiated or not? Step one. If you are, then great. Step two, if you're building your business, can you build it in a manner that enables you to weather the inevitable downturn? It's amazing. For the optimists that we are in our investing philosophy, once we invest, I feel like I'm the pessimist in the room saying, the world's going to die tomorrow. How much runway do we have? Do you have enough cash to survive? Are we going to be okay?
But it's interesting you say that, Sandeep, because your investments, a lot of them actually are in different areas, not necessarily in companies that are going the discount way, right? But I still want to get your thoughts on that, because, for example, we were speaking to Vijay Shekhar of Paytm, and even he admits that the whole discounting game has got to get smarter in order for the survivors to really survive.
So look, I think there's a sense that India is a scale country, right? So we must get big, because what we definitively have is 1 billion people at a low ARPU. So we don't monetize at the very high end of the spectrum, but we have a ton of them. And so let's figure out how to get to scale. Once we get to scale, we'll figure it out. And I think that that's fine if you have a belief that you have a product innovation or a user experience or something that's differentiating. I think really what's happening is everyone's driving a car really fast around the racetrack and continuously changing various pieces to try to make sure they find the one thing that they can hook onto and kind of win with. And it's really complicated and hard to do that. And suddenly, if everything changes and shifts on you, you have to suddenly slow down your car, and you put all sorts of pieces on that may not make sense, and you have to move those. And so, and you're expecting more capital to flow in. If you look at the recent uptick in the market, the last, let's say, 15, 18 months, have been fueled on optimism, right? It was perception. It wasn't, I mean, you guys see it on the public side, maybe there's a different answer, but I mean, look, on the private side, nothing fundamentally changed. All that happened was there was this belief that the world was going to get better. Suddenly, if the world isn't better, and if the world isn't better anywhere else, no matter how good it is here, we're going to have a bit of an optimism challenge. And selling the idea of the perception being better, sure, it sounds good, but it's not moving yet. And so as the market shifts, I think it's inevitable that people are going to retrench. And then suddenly you built your plan based on burning at a certain level. You're not going to get that money, and now it's going to make life hard. Well, one thing I think that you can do, and actually it's quite funny, Slack, which is a productivity software in the US, I think they raised something like $300 million. And the CEO said, we have decades and decades of cash now, right? I mean, that's really smart. People are ready to give you money, take it, don't burn it. Don't go nuts. I appreciate that you want scale. I appreciate that you want to win, but be ready for the downturn. Okay,
one more question I have for you, Sandeep. We're running a little out of time, but a lot of, as you said, there's this rush to achieve scale. So a lot of the startups that have managed to raise money, especially when the boom was at its peak, are of course looking to deploy that rapidly. What would you advise? Achieve that scale regardless of the market volatility, or perhaps sit on that cash for now until things are a bit better?
So I think step one comes back to optimize your business. Make sure that you have the core of it working in a manner. Again, the frugality that which successful businesses have operated at is amazing. Whether you take, let's take old world companies like Walmart and how they've scaled. You take even, now you can kind of say the first generation, which was Amazon, and how they approach things. You know, irrespective of all the other commentary on their work environment, I mean, they've been very good at making sure they're optimal. So step one, make sure your business is optimal. Step two, I don't think you can ignore scale. I mean, it's very challenging because if you're in a distribution business, which is what a lot of these discount-led businesses are, you have to have some level of scale. Now, I would say moderate it with what everyone else is doing, and so ideally the whole market will come down, everything will reset a little bit, and then you accelerate again. But don't expect that more money is coming tomorrow right away.